Mike was just talking about expectations that the Fed will now probably hike 25 basis points. We had obviously seen a very aggressive repricing of the hawkishness expectations from the Federal Reserve. We started to see that unwind. The 10-year real yield is now back down at negative 88 basis points. How does this translate into your world?
So the way it translates is that companies that have strong growth and are unprofitable or have low or thin profit margins have been negatively affected as rates have been rising. And to put some numbers around that, when real yields that you just referenced were negative 1% approximately at the start of the year, they dropped, if you will, or they rose, become less negative, around negative 50 basis points just before the hostilities and the war in Ukraine. Now they're back, as you said, negative 80 basis points or so. That is, when rates are rising, that is really a challenge for the valuation of long duration stocks. Long duration meaning their average term of their cash flows is far into the future. So that has been an area of great focus, and it's been particularly painful for portfolio managers, which are heavily concentrated in these sort of unprofitable, primarily technology, but in some cases also healthcare stocks. Those have been challenged. Now, they've had a little bit of a rebound as rates have moved the other direction and gone lower. But
is that going to stick, though?
No, our expectation is that that rates will continue to rise. And both nominal yields, 10-year U.S. Treasury yields will end the year closer to 2.25%. And you'll see real yields also rise, move towards negative about 15 basis points or so. That is going to be a challenge, will continue to be a challenge. And to keep that in mind, that these high growth, but relatively low profit margin companies, they were trading 100 days ago at 12 times enterprise value to sales. Today, they're 6 times. So they've been cut in half in about 3 months. And that has been really a challenge and problematic for, obviously, the companies.
Right.
Some of them need to raise capital, whether they choose to use dilutive equity offering or convertible offering. Somehow they need to raise more capital in order to keep growing, because they're, by definition, growing, but they're not so profitable. On the other hand, companies that are growing but have high profit margins, they are relatively more insulated, which is, I think, a general statement when I think about strategy. Owning companies that have high margins, that will be the distinguishing feature in calendar year 2022. Companies that have resiliency in their margins are likely to outperform significantly. And that goes across multiple sectors of the market. And the way you want to think about that is companies that have been able to generate and deliver very high and stable gross margins. Before the pandemic, during the pandemic, and after the pandemic, the last 5 years, if you've been able as a corporation to keep your margins high, that's prima facie evidence of their ability to have pricing power. And that is ultimately what people should be looking for.
David, there's a lot to unpack there, so let's try and start taking some of the pieces out of what you just said. Some of those stocks, how are they going to be affected by high energy costs? How are you thinking about high energy costs in terms of the stocks that you are currently screening right now? If we were to see oil coming down significantly or going up significantly from here, how does that change the mix?
Okay, Guy, well, the way to think about this is that, first of all, the energy intensity of the U.S. economy, and particularly the equity market, is relatively much lower than it was in previous episodes. And you have a much more technology-oriented, sort of growth-oriented, relatively low capital-intensive businesses comprise a pretty large, significant, sector component of the U.S. Publicly traded markets. And so, therefore, the higher oil prices, which obviously have spiked a lot, basically act as a tax and take a little bit of profitability from a whole host of companies and industries and transfer those into what turns out to be windfall profits, if you use that term, windfall profits in the energy sector. And so from an aggregate point of view, the amount of profits is still sort of similar. It just gets reapportioned, reallocated across the different components of the equity market. And so we're looking at earnings overall for the U.S. Market to be rising around 8% this year. And that's basically driven by the fact that nominal GDP growth is very, very high because inflation and real growth as well. But real growth is more modest, and real economic growth is decelerating, still growing, but at a slowing pace. And so in nominal terms, that's how companies report their revenues, in nominal terms. And so you got revenue growth. Margins obviously essential, and your point is an important one. Companies that have lesser or more energy exposure. But the energy is really not the key issue in terms of the profit margins. It's the labor costs Labor cost is the big area and the differentiating factor. And Guy, you want to think about it in the following way. The typical company in the United States has a labor budget, a labor cost of around 13% of its revenues. That's a fully loaded number. That's a salary and bonuses and stock-based compensation and option issuance. And in America, healthcare is a cost that's borne by the employer. And so we fully load that at 13%. Guy, you've got a distribution. Some companies at 5% ratio, some companies 25 or 30%. That's a variable that's probably more important from a profit margin perspective than the energy that you were asking about.
Well, and we know the Federal Reserve is looking at labor costs and wages as well. Speaking of the Fed, they have not yet hiked, and yet we've already seen financial conditions tightening. And I'm wondering how that translates into what kind of risk premium an investor is going to demand.
So in a tightening financial conditions environment, which is certainly something that we are anticipating at Goldman as the year progresses, both because the Fed is hiking, we anticipate they'll continue to hike, because bond yields are rising, and because you have other attributes of the tightening financial conditions that we use as a metric. Historically speaking, when you are in a tightening financial conditions environment, quality stocks do better. How do we define quality? Well, that is a stronger balance sheet, generally speaking, larger market cap, more stable operating margins. Those are attributes that traditionally have been viewed with characterized as a quality metrics. And they tend to outperform as compared with companies with more variable opportunity, or the idea of lower market cap, smaller market cap stocks are more challenged in general. So that's because smaller companies tend to have weaker balance sheets, therefore the tightening financial conditions have more of a negative effect on those companies. So that's really a playbook, if you will, based on history when you have these tightening financial conditions, which is I think, a challenge for a lot of companies.
David, a lot of people are trying to get their arms around the exposure that European businesses have to Ukraine and to Russia. We're still working our way through that process. A lot of uncertainty surrounding it. Do you expect, as a result of that uncertainty, do you expect, as a result of the potential growth hit that we're going to see here in Europe, that we're going to see money flowing back across the Atlantic? Is this just from a sort of geographical point of view, a situation where you want to favor U.S. equities?
So, guys, it's an important observation. There's sort of two competing developments. One is money flow, and money flow has been directed here in the United States towards non-U.S. equities. When you look at some of the flows in the mutual fund industry and things like that, that's been the pattern so far, and I would expect some of that to reverse. And one of the reasons for that is that here in the United States, the publicly traded equity market, about 75% of the revenues are generated by within the United States, or say within Canada. We'll call that North America. That's the source of the revenues. And so there's less sensitivity in terms of the demand from less sensitivity to, say, some of the situation in Europe for those companies here in the United States. Obviously, there are some companies that are more skewed towards their revenue exposure to Europe, but broadly speaking, the U.S. equity market is far more domestic oriented than many people perceive. I mean, the economy, the United States, obviously an important trading partner with many corporate companies and countries around the world. But the actual revenue source for many companies is highly domestic. Of course, there is supply chain issues that relate to the trading patterns, but actually the end market, and that's really a key variable. And our basic expectation is that the U.S. economy will be decelerating, but still growing. And that's, generally speaking, a positive for equity markets over time.